The next risk criteria which I look at is growth. See, I have a preference for companies which are growing. I know a lot of people are very happy with high dividend paying companies, companies which have reached maturity in their life cycle. But my preference is, companies which are growing, because I would like to see the business be much larger 10 or 20 years down the line. Now, it's not often possible to say with absolute certainty, but depending on the kind of industry you're focusing on, I think with a reasonable amount of certainty you can predict where the company is going to grow or not. Maybe not the exact growth rate, but in general it's possible to predict the trend. Now, let's look at the example of this company Best Buy. It doesn't take me more than a few seconds to eliminate ideas like this, because we can just see that there is absolutely no growth that's happening in the business. And I think a quick check like this will save me a lot of money and a lot of stress in the years to come. Next is the gross profit margin. Now, often companies might be growing fast, but they may not have the pricing power to retain their gross profit margin. And it can happen because of inflation. Maybe because of inflation, their cost of goods sold, that's going up, and the company is not being able to pass on its the price increase to its customers. Or maybe it's operating in a very competitive environment, and there are too many competitors who are coming and putting a downward pressure on its price. So let's take the example of GoPro. Manufactures and sells amazing cameras. Anyone who is into outdoor sports and who has used GoPro cameras, they know that they take amazing images and videos. However, having a good product does not necessarily make you a good business. Look at what happened to GoPro's gross margins over the last 5-6 years. In fact, there are lots of competitors who sell cameras that are good enough but are available at a fraction of the price that GoPro cameras sell for. So at one point of time, their gross margin used to be over 50%, and now it has shrunk to just above 30%. So for me, just a few seconds would tell me that no, I would like to stay away from this business. The next factor is operating margin, and I look for businesses, with the objective of eliminating them, businesses where the operating expenses are expanding, which means the management, they are not being able to control the costs, the fixed costs of the business. And again, let's look at the example of GoPro. The operating expenses have grown over the years, and we can see very clearly where it's coming from. Now, GoPro, obviously facing so much of competition, they are spending more and more on their R&D expenses. See, the research and development expense has gone up from sub 4% to over 30% in 2016, and now hovers between 15 and 20%. And that has pushed up their operating expenses. As a result, in the last 3 years, GoPro hasn't made any money. So, these are clear indicators that a gross margin or increasing operating expenses, these immediately tell me that I should just stay away from these businesses. Now, as compared to this, look at what's happening in Tencent Holdings. We all know Tencent is a large internet business based out of China. They are the owners of WeChat, QQ. They have several successful online games, and they also have a large portfolio of investments in other businesses around the world, other early stage businesses around the world. And the company is growing extremely fast. But look what's happening to their operating expense. The operating expense as a percentage of revenues has come down from over 27.5% in 2014 to just above 20%. So clearly the management is running the business more efficiently, and they are being able to control and bring down their fixed costs. So that immediately tells me that this is the business that I would be interested in researching, not necessarily jumping into and buying, but researching to know more about.